Namaste, hello, and welcome back to Vision Economics Academy. Today we'll continue with our chapter number 6, Banking, Commercial Banks and the Central Bank. In the previous episode, we have already covered as to what commercial bank is, the primary function, the secondary function, the agency function, and the general utility function. Today we'll be covering a very important part as per the boards, as per the chapter. It's very important, and I would like you to focus on this. Usually, the kind of question that comes here is you'll be asked to give with explain the process of money creation or the credit creation with the help of a hypothetical example. Now, how does a commercial bank creates credit? So through the process of money creation only, commercial bank are able to create credit, and it is in far excess than the initial deposit that they get. But the key assumptions that we take here is that entire commercial banks, when we are talking about bank, we are talking about entire commercial banks put together. So all the commercial bank system is denoted by one particular term, that is bank. So in our study, we are considering entire commercial bank system in one unit, that is bank. And all the receipts and payments, all the transactions in an economy is happening through banks only. So the deposit that is held by the bank is not fully lent, as we all know, right? A certain percent has to be kept as a reserve, and that fraction is called legal reserve ratio, right? Legal reserve ratio, and it is fixed by the central bank. In India, it is RBI, right? So why only a fraction of deposit is to be kept with the bank? Why not a major portion of it, right? The thing is that with the experience, we know that all the depositors will not approach the bank uh, at the same time for the withdrawal of money, and they will, even if they withdraw, they will not be withdrawing the entire amount. At the same time, simultaneously, there will be constant flow of deposits, new deposits also. So a fraction of the total deposit is kept as a reserve and rest is lended, through which bank obviously get interest, and they also invest and they earn profit through various ways. So let's go into the process quickly. Let's say in our example, we have taken cash reserves to be 20%, right? So initially, if there is a deposit of 1,000, now 20% has to be kept as a reserves. So 20% of 1,000 is 200, right? And after keeping 200 as reserves, the bank is able to loan 800, right? So let's understand in this way that a person A and person B is there. Person B has taken the loan from, goods and services from A, for which B has to pay him 800 rupees, let's say. All right. Now, B has bought goods and services. B got the loan of 800 and has paid to A. Now, according to our assumption, all the transactions are routed through the bank. So A will go and deposit 800 rupees back to bank. In the same way, the 800 rupees comes back as a deposit to the bank. Okay. Then again, 200% of 800 is 640, and 160 is kept as a reserve. And again 640 that was taken as a loan is being used, is being given to someone whom from whom a person would have got the goods and services from, and the person who have received it again will go back to the bank and would deposit 640. And we all know all the transactions are being routed through the bank. So again 200% of 640 is 128 and 512 is given as a fresh loan, and this process continues until and unless the cash reserves do not become equal to the initial deposit, right? And as we know the LRR is 20%, so the credit multiplier or money multiplier is 1 by LRR, which is 1 by 0 to 20%, which will give us 5. So the multiplier value is 5. That means the initial deposit increases up to 5 times. They are able to create 4,000 worth of fresh loans, right? As 100,000 is already the initial deposit, so they have been able to create 4,000 more, right? And the cash reserves accumulated, it'll be continuing, the process will continue until and unless it becomes equal to the initial deposit. So as we know the credit multiplier is 5, so the initial deposit increases 5 times. All right, so here I've also explained about the concept of money multiplier, right? Money multiplier or deposit multiplier measures the amount of money that the banks are able to create in the form of deposits with every unit of money kept as reserves. So money multiplier value, the formula is 1 by LRR, which I've already shown, and this is the example that I've already shown above. So multiplier value is 5, that it signifies that every unit of money kept as reserves, banks are able to create 5 units of money from every 1 unit of money. Okay, so the higher the reserves, the lower the multiplier, and lower credit we will be able to create. So the lower the LRR, higher the credit creation, right? And multiplier. Let's see this example. Calculate the total credit creation if the initial deposit of rupees 1000 crores and LRR is 12.5. See, now you need to understand that as the LRR is lower than the 20%, which was there in our previous example, now the multiplier will be more. So with this lower LRR, they can create more loans, right? So 1 by 0.125, that is money multiplier, I'm denoting it with, will give us 8. So the multiplier value is 8. That means the initial deposit of 1000 crores would, uh, create the total credit creation would be initial deposit into money multiplier 1000 into 8, that is 8000. Okay, so whatever unit it is, crores, lakhs, it is okay. Same applies here as well. It's a crore, you can write crore. If it's lakh, it's like lakh, or if it's plainly, you can write as a unit as well. Okay, All right. So this is the process of credit creation or um, money multiplier by the commercial bank. And in the next class, we'll also be covering or we will be starting um, central bank, right? So we will be doing functions of central bank, how what is the importance of the central bank, how do they control the money supply or credit, etc. So till then, please be safe, study well, and be happy. This is Shivankar sir, and we'll see you next time.